Let's look at the market as it is today, as it has been over the past few weeks. Treasuries are backing up. Credit spreads are widening. Yields on junk bonds, for example, have widened by 30 basis points in the past week alone. Are cracks starting to show in the credit market?
Well, certainly where we are in the economy is a time to be cautious in the credit market. So we're just seeing that, though. So the things that you mentioned are after a year of tightening spreads in high yield, tightening spreads in lots of the pieces of the market that we watch. So you're starting to see that. The treasuries at 3.25 was sort of a level that people were going to be nervous about. We're there.
That's where we are, indeed.
About it. And you have discussions about growth from there. So you have a lot of conversations about what happens if treasuries go to 5. And we think that that means you ought to be cautious in fixed income, particularly high yield, high grade. Those are places where you need to be a little careful today.
Is the 10-year Treasury headed to 5?
It's hard to know. The economy is certainly strong. And you see that in almost any measure that you see today, including in our portfolio companies. So in that regard, growth is in the market, and the Fed's going to continue to tighten, I believe. Does that mean treasuries gap out that much? I don't think so, but certainly you look for that risk when you're managing a portfolio.
How late in the credit cycle are we?
Well, in the economic cycle, we are certainly late in the economic cycle. So we're 10 years in or 9 years in, depending on how you measure it. It's been a very slow growth cycle, 17% real GDP growth over this 10 years compared to most recoveries that are 40% in shorter periods of time. So it's been slow and steady in this cycle. The credit market had its last mini cycle in early 2016, and we've been really steadily up and to the right since then until these cracks that you mentioned in the last couple of weeks.
But you would call them cracks, too?
I would call them cracks, yes.
If you had to bet on one thing, Dwight, that would snuff out the bull market, what would it be?
A lot of the discussion you hear today is about a trade war. That is certainly one of the things that everyone is watching. And while I believe that the various parties have a lot of reasons to find the right outcome here, and that's what will happen, a straight-out trade war would create issues in the market. That's number one, I guess, in my mind. Number two is disruption in the U.S. sort of political cycle. Are we going to approve budgets? The things that happened in the summer of 2011, where the market corrected significantly when the U.S. was not able to reach a budget agreement, was downgraded, and the credit markets and the equity markets fell pretty hard there.
It's amazing how far in the past that seems.
Yes.
But we could be living with it again. What about inflation? What about runaway inflation that causes the Fed to clamp down on monetary policy and makes 2018 or 2019 look like 1994?
Runaway inflation would always be a problem. That's not what you see today in the market. You see instead controlled inflation and deflationary pressures offsetting growth-driven inflation. And so we don't really see runaway inflation as an issue. We see more concern about just disruptive issues in the market than we do about some broad change in the economic structure.
Given that we're late in the cycle, everybody's beginning to look at what happens on the other side of the cycle. GSO is the world's largest CLO manager, correct? Credit structures didn't perform particularly well after the financial crisis. Are they going to perform better after the next downturn, whatever it looks like?
Well, I'll argue with you a little bit. CLO structures performed quite well in the crisis. They traded off. As a matter of fact, some of the best buys you could have had in the crisis were to buy CLOs.
Fair point.
But their recoveries were very high and losses were very low. So I would say CLOs will continue to have that trend. We don't see that we don't see the mortgage market issues that you saw in 08, 09 in the market today. We don't see that thing that is out there just lurking to cause us to correct. Instead, you see in the market today just aggression, sort of slight aggression everywhere. You talked about high yield. High yield saw spreads tighten this year. Treasuries were moving up, spreads were tightening, and high yield was able to hold into a return profile that you wouldn't have expected at the beginning of the year. High grade stayed that way for a long time. It started to fall this year. So it's more a series of small things that the market's been a little aggressive.
You're not a big holder of fixed rate instruments, though, are you?
We have a fixed rate business. We have a high yield business, but we are not. It's less than 5% of our portfolio today. As a matter of fact, 50% of our portfolio is in our leveraged loan business, which is floating rate, senior secured, protected in that recovery, in that market downturn and recovery.
You've put a lot of money to work, a lot of capital to work here in Europe. What in Europe is especially attractive right now?
I'd say the most interesting thing about Europe is it's 2 to 3 years behind the United States. So the recovery in the markets, the recovery in the economy, Europe is just not as mature. So when you go sit in front of a client, there are not as many banks calling on them. The capital markets are a third the size of the U.S., so the high yield market's a third the size, the loan market's a third the size. And so they don't have as many options. And if you can go in and solve a problem for them, a private company, for instance, you're going to have a better chance of structuring something that makes sense.
Will you be growing your book faster here in Europe than you will be in the U.S. over the next, say, 2-3 years?
We certainly have seen more good opportunities out of Europe for the last 3 years, and we expect that to continue for the next few years and continue to grow that business.
Hard Brexit, a topic of much debate here in London. Good or bad from GSO's perspective? Or better yet, Dwight Scott's perspective?
Well, certainly we don't want fundamental broken market disruption. However, we have $20 billion of drawdown funds that have capital, $20 billion available in drawdown funds to react to market disruption. So would we see some of that in a hard Brexit? Yes, we would see some of that. Do we really want that to happen, and do we think that's going to happen? It seems likely that there's got to be a political solution that's a little better.
So on the one hand, may not be so good, certainly not good perhaps for the economy, may not be so good for some of your credits. But on the other hand, I see a twinkle in your eye.
You see an opportunity.
Blackstone ran one of the largest direct lending platforms until you exited that business last year. KKR ended up taking it over. Now you're going back into direct lending, and you've talked about a $10 billion near-term target for assets. Where will that business go after 10? How big a business should it be for GSO?
You have to go back in time and remember why we got into direct lending. We built our business with distressed, mezz, our leveraged loan business, which is our CLO business, and there was a hole in our strategy where we had these sort of 8 to 10% return loans that we thought the risk reward was very attractive, but they didn't have enough return to go into some of our other funds. So we built the direct lending business to address that. I think that's going to continue to be a very large opportunity for us for the foreseeable future.
Now, Dwight, before I hand it back to Alex Steele in New York, I'm going to ask her a question I know she'd want me to ask, and that's about energy. Brent is trading at $85. You know, WTI is some $10, $12 behind. Blackstone managed the downturn in oil and the subsequent recovery brilliantly. What are you doing now?
It's hard to even understand what's happening in the capital markets for energy, because what you said is true. Commodity prices are coming back for oil, not for natural gas. Natural gas is still weak. But for oil, commodity prices are coming back. But the capital markets are still hands-off to a large degree. Equities are still down from the top, somewhere between a third and 50%. Credit's still hard to find. The banks are still really inside their shell protecting themselves. So we see opportunities to put capital to work still in energy that are unique compared to most of the things that are, as you said, late in a cycle but haven't cycled the way energy has. Quickly before we run,
As a lender, do you think there's a stronger likelihood of Brent hitting $100 or going back to 70?
Forecasting Brent is a very difficult thing to do. It depends on what happens in the economy. It depends a lot on what happens with political disruption. Part of what you see in Brent today is political disruption around Iran, and so it depends on where that goes. I would bet more towards 70 than I would towards 100, but that's probably more my nature and what I do for a living, which it doesn't do us a lot of good for it to go to 100. It hurts us if it goes to 70, so we watch that a lot more carefully.